Rate My Portfolio is a new video series we're doing here at Nanalyze where we take one of our paying subscribers and evaluate their assets under management with the goal of providing insight to make their investment process better and, of course, add value to the broader community. Now, the gentleman you see in this picture, that isn't Jim. So Jim has actually a much more luscious beard than that. That's just an anonymous person. And Jim isn't actually this individual's name. That's because we like to keep things anonymous. And that's also why we stick to weightings, because the amount of money that you make or have saved is relative to everyone. So we always keep it, we stick to weightings. Half our audience is international, so we avoid discussions of tax law. We try to guide, not dictate. Adhere to basic principles of investing, such as diversification, and this is certainly not financial advice at all, the usual caveat there. So let's meet Jim. He's a 37-year-old American, United States citizen. His risk tolerance, so medium to high in tech and medium to low for all other investments. He likes a bit of a flutter, and I do too. So if you're somebody that is attracted to gambling for whatever reason, psychologists have shown that humans prefer uncertain rewards to certain rewards. That's why people like gambling. Then you want to be aware of that inclination and manage it. And that's what Jim's doing. The fact that he brought that up shows that he's aware of that. Now, his risk tolerance has certainly gone down ever since he got married and now has young children. He did a great job of chasing down all the data for today's presentation. So let's start looking at that. Assets under management breakdown. So most of Jim's wealth is in retirement accounts, about half. And you see here we've listed retirement alongside home equity. Now, stay or go. Do you include home equity in this asset class breakdown? I think if you plan to stay in your home for the rest of your life, then perhaps not, since you don't ever plan to derive any income or wealth from that particular asset. But if you consider your home as something that you might sell in the future and potentially, let's say, rent your house or use that as an asset, then it probably should be included on your assets under management. However, be prepared for volatility, because all it takes is one recession to drive that number down to zero. And then we look at the other assets that Jim has here, dividend stocks and tech stocks. So let's start talking about the biggest asset class here, which is retirement funds. He lists these out. State pension, we don't know how they're investing their money, but that's 16%. And these percentages are the percent of the total retirement value that you saw on the previous slide. He has a 403B with across four various funds. He didn't dig into that because it's not very significant in the overall bigger picture. This IRA with Gabella Utilities Fund, we're going to talk about that. And then a 401k here with Vanguard Retirement Fund. Vanguard makes great low-fee products. I didn't look at this one in particular. That's because we're going to focus on the Fidelity Freedom Index 2050 Fund. And whenever you see funds with these dates in the future, they're retirement funds, and their strategy is such that they expect you to retire around that target date. Now, I very quickly wanted to point out an example of how these retirement accounts can fleece you. And there may be no good alternatives in this particular IRA. I don't know, but I would recommend that Jim takes a look at what other alternatives exist here, even perhaps converting this into a self-directed IRA. Because look at this fund. So the Gabella Utilities Fund charges 1.39%. That's really steep. So your average ETF these days, I would think, is under 0.5%. But these individuals are charging 1.39%, and look at the dreadful performance. And I wanted to point this out because it's important. They haven't just underperformed the category, so utilities, right? It's a utilities sector ETF, so they've underperformed all other utilities companies. They've underperformed their own index, which actually outperformed utilities. So if these guys weren't fleecing so much money from this fund, and you'd really need to dig into the mechanics of this to understand why they are so far away from their index. Their tracking error must be ridiculous. But you're paying a lot of money to underperform broader utilities and the index that this fund uses. So I would certainly look at and see if you could make this a self-directed IRA or see if there's any better options there. Not a bad idea to invest in utilities right now because we know that utilities are taking a hit because of high interest rates. So that's actually a good time to invest in utilities. Now let's talk about the Fidelity Freedom Index Fund here, the Index 2050. This is basically how it works. You can see that far away from retirement, it's heavily weighted to U.S. equities and international equity funds, and then it starts to increase into bonds and short-term funds over time as you approach retirement. And then as you go into retirement, the idea being that you would continue to hold this fund. It's 55% of Jim's retirement portfolio. But I wanted to point something out here to pay attention to. So looking at the prospectus, he's paying 0.75% for this fund. Okay, maybe we can live with that. But when you see here the asset allocation to underlying Fidelity funds and futures, of course, this is a fund of funds. So as you can see in this picture here, they've allocated these monies to different funds to get these asset class exposures. But then when you dig into the details, you see it's actually invested across a ton of funds. And that's fine, but there's two problems here. One, is Jim incurring transaction fees here? And I didn't see this in the prospectus. These would probably be questions to ask Fidelity. I would imagine no. I would hope not. They should be included in that 0.75%. But the more important question here is Jim paying the management fees for every single one of these funds that his umbrella fund is invested in? If he is, he's being double taxed, and that's total BS. So I would certainly look into that because I didn't see the answer to that question. I would totally assume that Fidelity would not be double taxing here. But you need to ask those questions, right? You need to understand how your money's being invested and managed. That's very important, right? Keep these people honest. So let's talk about Jim's stock portfolios. The tech stocks that he's invested in represent 1% of his total wealth, so a small number, but as we said earlier, he wants to increase risk since he's younger, so perhaps he'll be overweighting. He's doing dollar cost averaging every month. He's increased that, and it said he would be going into tech more. So you notice here these weightings, and this is fine. So you have the large quality companies, ARM, Snowflake, CrowdStrike, Taiwan Semiconductor. He's overweighted those in his portfolio and seems to be underweighting the rest. That's fine to do, but set a target weighting structure. So say something like, all right, these companies I have a high conviction on. I want to do this percent across the board, and these others that I have a lower conviction on, I'm going to have a lesser percent. Come up with a rhyme or reason of why you have these weightings. And maybe he does. It seems like he might around the size of companies. But I would also hear he's classified geography. That's great. But put in the theme as well so you know exactly. That reminds you of why you're investing in these different companies. Dividend stocks. So this is a great looking portfolio with some solid names. I wanted to just point out a few things here. First, UPS is heavily overweight, and we see this with other people's portfolios, and that's usually a stock they have probably have held for a while and have strong convictions on. Usually there's some personal reason for that. Maybe it was recommended to them by somebody else, or perhaps a family member worked there or something like that. Maybe they were given those shares as a gift. Hard to say, but that's fine, I think, because remember when Fidelity did their audit of retail accounts, they found that the people who died or forgot they had an account would perform best over time. So if you want to hold something and say, listen, I'm always going to hold that, I'm not going to get rid of it, that's perfectly fine. He's probably allocating funds across the other names which will decrease this overweight to UPS over time. The other thing here, this Schwab U.S. Dividend Equity ETF, that seems redundant because you already have a diversified portfolio of dividend stocks. You're not really gaining anything from that. So perhaps you could just skip that and allocate those funds across your selection here of dividend stocks. Now, just some other comments on what Jim said. He says he feels because he's youngish, mid-30s, relatively low debt, finished paying off student loans this year. Congratulations, Jim. That's awesome, man. You got to get that debt down. You want to always hold zero debt. That's important, with the exception of your mortgage. Now, he has equity in his home, and they've established relatively safe careers. He says, I can afford to be riskier with our stock portfolio. Indeed, so he's associated his age with his tolerance for risk, which is great. Then he makes the comment here, I don't want to be dumb about it, though I had some dumb luck on options and penny stocks before joining the Nanalyze community. I'm grateful I didn't make too many expensive mistakes. Great. You made those mistakes. You understand that's not the path to wealth, no matter what the pundits try to cram down your throat. So Jim's approach, or how he thinks about investing, is great. He's very self-aware. We asked, are you investing every month using dollar cost averaging? He says, yes, but only in the past 6 months. Perhaps that's because before he was paying off his student loans. Generally, we'll put 75% into dividends and 25% into tech. Okay, that's fine. So he's actually overweighting the dividend portfolio. That's perfectly fine. He said, and here's that comment, I had some existing investments such as UPS that I just don't touch, and that's perfectly fine, Jim. He says he's looked into alternative assets, but will probably continue with his current plan. So I think he mentioned wine and whiskey. These are fun things to invest in using the VinoVest platform. And they also have, they're also investable because they're not correlated to the equities market. He says our biggest expense now is daycare, and in 9 months it will no longer be an expense. Great, so that money can go right into investing. We mentioned the home equity and maxing out employer matching. I think he had one account that the employer matched. You always take free money, right? That's a no-brainer. So general comments to Jim, good job on maxing out your retirement accounts. Dollar cost averaging consistently over time is very important, so try to do as much of that as you can. Managing your own investment portfolio is a great idea because you learn about the process and you can keep the experts honest. That's very important, right? And the earlier you sacrifice, the bigger the rewards are going to be later on. So Jim's got a good 30 years of investing left. And today's presentation is focused a lot on pensions and retirement plans and the sort of retirement options that exist for U.S.-based investors. And because half of our audience is from the United States, I think it would probably be worthwhile to do a presentation that just looks at retirement accounts and the various options that exist out there. So look for that in the future. Now, just to conclude, lots of Americans don't take their retirement accounts seriously, and I think that in today's presentation we've seen why it pays to dig in a little bit and see who you're paying fees to and what they're doing for you. You should always max out any option with tax advantages or free money. Don't put all your riskiest assets in retirement accounts. So this came up. I thought it was an interesting thing to think about. If you have a self-directed IRA as an example, so that's a retirement account that you can choose your investments yourself. If you put your less risky assets in there and then you put your riskier assets in a brokerage account, that allows you to write off losses against your riskier assets because it's more likely that you're going to lose money when you invest in risky assets. So that was an interesting thing that we thought of. When it comes to tax advice and things like that, you're better off asking a tax professional, though we are going to touch on that in a coming research piece because it's such an important topic. Learn to sacrifice early on. That will pay dividends literally down the road. And since Jim has children, it's very important that he teaches them how to accumulate wealth so that there's no more, you may have heard this term, shirt sleeves to shirt sleeves in 3 generations. It means that typically when one generation does a great job of accumulating wealth, 2 more generations down the road and it's already spent. So it's very important to pass down to your children the fundamentals of investing. And I'm going to put up a video that we put together just on that topic. Before you click that, please click the Nanalyze logo on the right, like this video, help share it, and support us. Thanks so much for taking the time to watch this today.